All right, today we are diving deep into the latest Bank of England financial stability report. And we're going to unpack a major paradox at the heart of our economy. Why, when things on the surface look better than ever, are financial regulators getting so worried?
I mean, if you just look at the headlines, you think everything is fantastic. The Bank of England's own report points out that major indexes like the S&P 500 have been smashing records. There's this feeling of real strength, a ton of optimism in the public markets.
But, and this is a big but, beneath that shiny surface, the watchdogs are sounding the alarm. So that brings us to the big question here. If the markets are booming, what in the world has the Bank of England so concerned?
Okay, and this chart right here really tells the story. That orange line, that's stock market volatility. See how low it is? That's the market looking super calm. But the blue line, which is economic policy uncertainty, is still way up there. And it's this huge gap between the two that's making regulators really nervous. It kind of suggests that the markets might be ignoring some major real-world risks, which could set us all up for a really sharp, really painful correction.
So, let's start with the diagnosis. We're going to look at some of the strange symptoms that regulators are seeing. Symptoms that suggest the economy might be running a bit of a fever, even if it looks perfectly healthy on the outside.
And the Bank of England's analysis here is pretty blunt. On this chart, the lower the dots go, the riskier the assets. You can see a whole bunch of them are deep in that risky territory. The bank actually uses the phrase materially stretched to describe these prices, and they're drawing a direct line back to the dot-com bubble. The big fear is that asset prices have just become dangerously untethered from their actual value.
So, what's one of the key symptoms causing this economic fever? Well, while the big markets are roaring ahead, the UK's real economic engine room, we're talking its most innovative companies, is basically being starved of fuel.
So who are these companies? They're called high-growth firms, or HGFs, and they are literally the future, pioneers in things like AI, biotech, you name it. But here's the problem. They're young, they don't have a long track record, and their biggest assets are ideas and intellectual property, not big factories. So a traditional bank loan, it's just not going to work for them. They need a totally different kind of funding to get off the ground.
And this chart just lays the problem bare. When you look at venture capital, which is the exact fuel these HGFs need, the UK is seriously lagging. This chart shows venture investment compared to the size of the economy, and you can see the UK is way behind competitors like the US and Canada. We've got a real structural problem with funding our own innovation.
Now this one is just stunning. Look at the bars on the left for the smaller funding rounds. See all that blue? That's UK investors. But as the deals get bigger, as you move to the right, watch what happens. The orange, that's international money, completely takes over. Our own homegrown capital just dries up, forcing our most promising companies to sell big chunks of themselves to overseas investors. This is the funding gap, right here in plain sight.
Now, this funding gap isn't just a UK problem. Innovative companies all over the world are facing it. And wherever there's a problem in finance, a solution usually appears. Stepping into this vacuum is a new kind of medicine, an alternative source of funding that is just mind-bogglingly huge.
Just take a second to let that number sink in. $15 trillion. That is the estimated global size of this alternative universe of funding we call private markets. It's a colossal ocean of capital that operates completely outside the normal public stock exchanges.
So what exactly are private markets? Well, to put it simply, it's money from places like private equity firms, venture capital funds, and the fastest growing bit, private credit. These are the guys who step in to provide the loans and the investment that regular banks and stock markets can't or won't provide, especially to those high-growth companies we were just talking about.
But here's the catch. Like any powerful new medicine, this one comes with some very serious and not very well understood side effects. The very thing that makes these markets so useful, their privacy, is also what makes them potentially really dangerous.
And to understand these risks, we don't have to imagine them. The Bank of England report points to two recent real-world corporate failures in the US that serve as a huge warning sign: an auto parts supplier called First Brands and a subprime auto lender called Tricolor.
And here is the absolute crucial point: the total disconnect between what people thought was happening and what was really going on. On the surface, what lenders and credit rating agencies saw was a stable company with manageable debt. But underneath, hidden from view, was this tangled mess of crazy complex structures, tons of debt hidden off the books, and even, in the end, allegations of fraud.
So these two failures, they basically give us a perfect summary of the systemic risks that have regulators so worried. You've got extreme opacity, where nobody can see the full picture. You've got hidden leverage, debt that's piled up where no one's looking. You've got weak underwriting standards. And finally, this dangerous over-reliance on credit ratings that turned out to be completely blind to the real danger.
And hey, don't just take my word for it. Here it is, straight from the Bank of England. The key word in that whole quote is propagate. Because everything is so opaque, nobody really knows how a failure in one corner of this $15 trillion market could cascade, like a domino effect, through the entire financial system. It's a total black box.
Okay, so you're the doctor. You've got a feverish patient, and you've got this powerful new medicine with some really risky side effects. What's the prescription? Well, the Bank of England's answer is to try and get a look inside that black box.
The bank is launching something it calls a system-wide exploratory scenario, or SWES for short. Honestly, the best way to think about it is like a full-body CT scan, or a financial X-ray, designed specifically to map out all the hidden connections and weak spots within these private markets.
So how does this financial X-ray actually work? Well, it's basically a four-step process. First, they gather mountains of detailed, confidential data from all the banks and funds. Second, they cook up a really severe but plausible crisis scenario. Third, they watch and analyze how everybody reacts under that intense pressure. Who sells what, who goes bust, who's scrambling for cash. And finally, they publish the big picture results, anonymously of course, to show everyone where the hidden dangers are lurking before they have a chance to take the whole system down.
And all this brings us to our final, lingering question. The Bank of England is building this incredibly powerful new telescope to peer into the shadows of the financial universe. But in a system that's filled with so much financial dark matter, all this invisible debt and all these hidden connections, can regulators ever really see the next crisis coming before it's too late?